Good day. With the news out that South Africa officially entered a technical recession, let's quickly just unpack the numbers and understand what it means for us as a country and for you as a client. When you enter a technical recession, it means that you had 2 consecutive negative quarters. So we had a minus 2.6 in the first quarter of this year, and then yesterday a minus 0.7 for the second quarter. Now, unfortunately, a lot of the opposition parties on the political front will put this in front of Cyril Ramaphosa. But in all fairness, if you think about this is still legacy stuff from 10 years of corruption and mismanagement. And then if we add to that the current turmoil in the global economic environment, especially emerging markets, that's also acting as a bit of a headwind. Despite that, yes, it is tough, and we've been saying that forget about the technical recession, the fact that South Africa is growing well below its population. So the year-on-year growth right now is only 0.4% versus a population of 1.6, 1.7%, implies that we are actually moving backward per person in this country. The government's still got a lot of work ahead of them. And in all honesty, the kind of policy changes that we are seeing at this point in time will be able to result in real numbers going forward. But given our structural challenges, it will take years before we see that in the real numbers. As long as Cyril Ramaphosa can stay in power, continue with the policy reform, and very importantly, we get some clarity on the land issue and also on the mining issue, there's still real upside to the economy going forward. Despite the negative numbers, I do think if we can highlight a couple of positives, is the fact that we've seen quite a rebound in mining, we've seen a rebound in construction, and also in trade. And that's part of the growth engines of the economy. Manufacturing remained quite weak, which is quite a big sector, and we would like to see that to pick up going forward. And probably the biggest negative impact again was agriculture. And we highlighted this before last year that agriculture had a very good year in 2017, coming from a low base and probably the biggest crop season on record in South Africa. So we did expect that this can't continue going forward into this year. And as a result, agriculture had quite a negative contribution on the second quarter of a minus 30%. Now, what this means is, as you probably already saw, is quite a big impact on the currency. The rand traded just above 15 after the release, and also the bond markets took a bit of a knock. The budget next month is going to be a severe challenge because where we started the year with numbers around about 1.5%, the numbers now are probably going to be closer to 0.8% growth. And if you add to that, since February, we had further items on the expenditure side in terms of real wage increases for the public sector, the national health insurance, and also Cyril's potential stimulation program. So next month's budget is going to be a very tough budget. And unfortunately, it's still putting us in a position that we might get a further downgrade, which might put further pressure on the currency going forward. From a portfolio point of view, we are proactive and we've been structured the portfolio in a way that we are weatherproofing emerging market turmoil, that we've got more offshore exposure, and that we are probably benefiting from a weaker currency at this point in time. Until next time, goodbye.